Oh, good morning, West Coast. Good afternoon to the East Coast and everyone in between. Good day. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. It's nice to have you with us here today. We've got a couple of really fun topics. We had done some past presentations with these folks, and they were so good. We had so many requests for review. We kind of put two of them together, give you a little bit of a taste of the resources and the level of guidance and education that our members receive at the Center for Tax Strategy and Resources. If you're not familiar with us, we're not an IMO, we're not a broker dealer. We don't care where you place your business. What we are is, I think we've been best described as a study group on steroids. We've got a huge faculty of subject matter experts. People try to apply to join our group, and they have access to these specialists, including 3 tax attorneys, a couple of CPAs, and then just about everybody else in the business that you might need to help move your clients forward, introduce them to new ideas and concepts, and raise your practice revenue, which after all, that's kind of what it's all about. Better solutions equals better revenue. So today on these two topics that are covering, Simon Singer, who is, if you don't know Simon, he's been in the industry since 1964. He's written 3 business bestsellers. He's a very sought after speaker, and he's in the top 0.1% of all advisors in the US. He's also the founder of the Center for Tax Strategies and Resources. And as far as being a big producer, he's one of the people I met when I first met Simon, going, wow, you're not only willing to tell me what you've accomplished, but how you accomplished it. So his topic today is going to be talking about 25 critical estate planning questions that you'd want to ask your clients, and 39 family-owned business questions. At the center, we talk a whole lot about how to use the proper words and timing, how to make yourself more effective, how to do better discovery, and what solutions are available out there that you may not be aware of. And then immediately following that, Simon goes on for about 20 minutes or so, so you get a nice cross-section of that presentation. Then tax attorney extraordinaire Joe Struzzieri, who is founder of multiple organizations, including his own practice, but he's also the Southern California Laureate Program. Was by his design, as well as multiple tiers of his practice. Does a lot of work with business succession planning and tax efficiencies. So Joe is one of our faculty members. He's going to talk about 10 ways out of a highly appreciated asset. So that runs about 22, 23 minutes. Sprinkled in between, I'm going to tell you about an event we have coming up pretty quick now. It's actually going to be in May, early May in Vegas. I'll tell you about that once we get to the break, and then let you know how you can reach out to us if you have additional questions about the membership or the Academy event. So without any further ado, enjoy the show.
This is my favorite, to be honest with you. If it wasn't for my ability to be able to do discovery, I am just not the smartest guy on this planet. I'm pretty good at parroting what other people do, but what I've discovered was we've all read an interminable number of books on answering objections. I will suggest to you that while I got really good at answering objections, I did a lot better financially and a lot better for my client once I learned how to ask better questions. So when the title of this is Eliminate Your Favorite Closing Line and Double Your Production, because you likely won't need it, as Brad said. So as I said, prelude to the Virtual Academy. I will tell you that this world, whether it be assets under management, insurance, or fee-based planning, it's not the product or the strategy. It just is not. It is discovery, finding out what's in the client's mind, not just what he puts down on a piece of paper, but finding out what's really going on in his head and his heart. And yet all anybody ever talks to this guy about is his pocketbook. Discovery, 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 and you do that by answering questions. So we're going to list a whole bunch of powerful questions. You don't use them all, but they're kind of a lead-in to getting them to tell us what's on their mind. Because if we just lecture them, lo and behold, we finish our lecture and we lost them at the opening and we didn't realize it. So here's a few of them. What's your largest expense? Do you have anybody that pays your taxes for you? Mine are killing me. With a $26 trillion deficit, do you think taxes are going to go up or going to go down or stay the same? And then tell me a little bit about your CPA, your relationship with him, and your opinion of taxes that you're paying. Too much, or is it about right? The whole idea is it is not relevant what their answer is. What's relevant is that you listen carefully to what they said and how they said it. And then I'm going to go into what you do afterwards, because that's a point where a lot of people fail. It's not just the question, it's the question after the question. So let me go through some more questions. What have you done to create tax-free income for retirement? How much of your retirement account is actually yours? It's interesting when you fill out a financial statement to get a loan at the bank. They ask you about your assets and liabilities, but when they ask you about your qualified plan or your IRA, they basically just ask you how much is in there. They treat it as an asset, but they don't treat the 40 or 50% of taxes that are going to have to be paid in order for you to get to that money. They don't list it on the balance sheet. So, do you have the cash to pay the taxes on your IRA or profit sharing plan distributions? Did you know you can have guaranteed income for life? Do you know that estate and capital gains taxes are voluntary under certain circumstances? What have you done to protect yourself from lawsuits, liens, and judgments? Did you know that you can actually insure your IRA or profit sharing plan? Did you know the IRS can actually give you a tax deduction for today for a charitable gift that you actually don't make until after you and your spouse have passed away? Have you ever lost money in the stock market, and can you afford to lose it again? Did you know that there are processes available that will pay you tax-free income if you live too long, die too soon, or need long-term care coverage? Okay, remember, these are just opening questions. And by the way, if you go to our website at the finish of this thing, you can click on important questions. It might say 11 important questions. You can click on there and you can get a copy of most of these questions. But remember, these are just opening questions. So the sale is in the question after the question. So the guy says, well, yeah, I think I'm paying too much in income tax. So he's answered your question. You might say to him, well, what are you doing about that? He'll say, I don't know. Well, what has your accountant suggested? He said, my accountant never suggests anything. All you're trying to do is get deeper and deeper and deeper into the process, not just rely on a data sheet. So being able to ask further clarifying questions is the difference between a small sale and a larger sale, or a sale at all. So here's 25 critical estate planning questions. These are available to our members. The Center for Tax Strategies and Resources, a membership organization. It's not an IMO, it's not a broker dealer. You don't have to change your contracts. It's just if you'd like some mentoring and training from the people at the highest level in our industry, it'll cost you a few bucks a month in order to be able to do that. So here's a sample of the questions. How would you define financial independence? How would you define wealth? How would you define estate planning? How important is ownership of your assets? How important is control of your assets? All of these things are just leading them to say, well, that's really important. If I can't control my asset, I can tell you right now, we can't get an estate planning case done if that wealthy guy doesn't think that he's got absolute dictatorial control of his assets. But nobody's ever explained to him that there's a difference between ownership and control. Are you or your family members at risk for claims of judgment creditors? So that might open a question about, so your daughter is marrying that tennis pro that you don't like. What if she gets divorced? Do you want the family assets to be divided among your future disenfranchised ex-son-in-law, or do you want it to go to your daughter and your grandchildren? It's a way to continue and expand on the conversation. What's the largest charitable gift you've ever made? Who'd you make it to? How did it make you feel? Here's some more. The way your estate is structured today, how much do you think is going to the government, your family, and charity? Let's see, how important is ownership? What's the largest charitable gift? Rank for me how you would value family, honesty, integrity, education, relationships, respect. They're not going to have immediate answers. It's going to cause them to stop and think. And we have some forms that basically say, we want you to prioritize these and tell us what of these areas are most important to you. It has to be modified. If somebody owns a business, he might want to be talking about key person insurance. It just has to be modified specifically. They're just examples. If you had an extra $1 million, but you couldn't spend it and you didn't want to give it to your kids, where would it go? What would you expect them to do with it? Are you aware that capital gains tax and estate tax are voluntary? Do you feel a sense of responsibility to your spouse for contributing to you acquiring and building wealth? Do you believe your current assets and cash flow are more than sufficient to maintain your financial independence, including inflation, health expenses, economic downturns, and other unknowns such as taxes? Remember, we got a $26 trillion deficit. The chances of the tax code, the tax brackets remaining the same is almost non-existent. How would you define financial independence from a cash flow and asset perspective? Do you feel any particular responsibility to conserve your assets for your heirs? And I'd like to get him to say me, I don't really care what my heirs get. I'm worth $50 million. 25 million after estate taxes is plenty. Nobody ever left me anything. I don't want them to become trust babies where they don't have any responsibility themselves. And then I'm going to go into a conversation about how We're not trying to make rich kids richer. We just want you to know that you have a choice of where that extra 25 million goes. It goes to your choice of children and charities or the government's choice of children and charities. Pick them. You got 3 places. It can go to your kids, it can go to your family, it can go to the tax man. Pick 2 out of the 3. So think about those things. So these are additional questions. Do your children all possess the necessary skills to manage your family worth? You will hear all kind of things, but very rarely are all of the children in possession of the skills necessary to manage the worth. You feel a responsibility to mentor your children to prepare them to manage family wealth, or grandchildren if you're dealing with an older family. If you were physically or mentally incapacitated, would you be comfortable with your children making financial decisions with regard to your health and maintenance? What you're feeling about charity. I'll hear charity begins at home. Well, sometimes I think the reason that more charitable structures aren't created is because people have misunderstandings as to what the word actually means. So if I said to somebody, I want you to create a charitable remainder trust, they hear the word charity. They'll say, you know, charity begins at home. I want to make certain I maintain control of my assets. So I don't want to use words that exactly describe what the strategy is that I'm referencing. I want to use words that describe what the strategy does, not what it called. So I might say something like, did you know that capital gains taxes are voluntary? Wait for the answer. Did you know that estate taxes are voluntary? Did you know if you voluntarily opted out of capital gains and estate tax, the government would actually give you a current income tax deduction today just for opting out of those other 2 taxes? Were you aware of that? They will always say, no, I'm not. I said, wait, I'm not done yet, because if you set up this series of buckets, not trusts, but buckets correctly, you're going to be able to invest those assets whatever way you want to. You'll never pay taxes on the gains again. You'll be able to draw it as little or as much in the form of income. You will pay taxes on the income that you choose to take. You can actually become a multi-million-dollar philanthropist supporting numerous worthwhile activities, all under the dictatorial control of your family in perpetuity, and do it without disinheriting your children. Were you aware of that? Well, all I described was a net income with makeup charitable remainder unit trust, a family foundation, a life insurance policy, and an irrevocable trust. But think about what people think about. Life insurance, that means I have to die to win. Irrevocable means I can't change my mind. Charity means I'm going to be poor and I'm going to disinherit my children. I don't want them thinking that. I want to control what they think by the use of proper structure and proper words. I hope that makes sense. Let's see.
It does. Let me jump in there a second, Simon. The beauty of that, and I just got off a webinar, 3rd meeting with the client I'm working with, and one of the advantages of going through those critical questions with them, and also the other form you mentioned would be kind of the goals and objectives form, is I've started every one of those meetings with a review using those 2 documents. So the answers to those questions that we had through discovery, and then their goals and objectives, so that I wanted to make sure we're on the same page. I wasn't doing it because I forgot what they said. I wanted to make sure they remembered what they said and what we had agreed to. And today was the explanation of the insurance solution, and it was ridiculously simple. Yeah, that makes sense. I can see why you did that.
Well, we're going to get to the goals and objectives in a minute. I'm just kind of setting the stage right now. Then we've got 39 family-owned business questions. So are we committed to the future of our family business, meaning them? Are you committed to the future of the family business? Some will say yes, some will say no. What kind of exit strategy do you have? Do you plan on selling the business? Do you want to sell it internally or externally? There's ways to be able to set up the business in a fashion where it becomes worth more than what they're doing right now. Must we offer every family member a job? Every family-owned business that I've ever dealt with always has the son-in-law of the daughter who owns stock in the company, but she doesn't participate in the company, and her husband doesn't understand why his compensation isn't commensurate with his ownership. Now, the fact that he never shows up and the fact that he never produces anything is completely missing from his thought process. I'm an owner, therefore I should be paid salary just like everybody else. Should in-laws or other relatives be invited to work in the business? What education or preparation should be required of family members who work in the business? How do you assign titles and work responsibility? How do we evaluate and pay family members who work in these businesses? How do we select the next leader? When do we decide who the next leader is going to be? It just goes on and on and on and on and on. Again, you can get access to these, or the members can. Let me just keep going a little bit, because I want to do some important things. So how to have a successful meeting is dependent on how you set the stage. Think about when you go to a play, when we used to be able to go to plays, or a concert or a movie. You saw something advertising the event that was attractive to you. Then you saw potentially somebody that did a critique of the movie, for instance. But in this case, when we're trying to have a meeting with regard to financial services, you have to be prepared. I can't even remotely tell you how important it is to practice like you play. Excuse me, I'm going to reverse that. How you're going to play the way you practice. So it's important to be practice perfect. You have to be well introduced. You have to find out why they are there and what they're hoping to accomplish. You have to listen carefully to their phrases and their responses and just how emotional or unemotional they get about particular subjects. Don't be afraid to ask further questions to those initial questions. You're trying to gain clarity. Don't accept their first response because it's almost always their way of trying to end the conversation. Finally, this is so important. Just because they ask a question does not mean that you must provide them an answer. And I can't tell you how much money and time I've spent on books and tapes on answering objections. The bottom line is, we don't necessarily know what they mean by the objection they just gave us, and they don't necessarily know what they mean by the objection they just gave us. So you might say something to them like, that's an interesting perspective. You know, that means different things to different people. Tell me what it means to you. And you'll find that a lot of times that objection just kind of disappears into the wind. So sometimes they might give you another type of objection. You ask them the same type of question. Interesting perspective. Tell me why that's important to you. You don't have to give them an answer just because they give you an objection. Okay, here's a generic opening that I've used probably a dozen times now. And it's generic in estate planning. There's a similar one with regard to retirement income planning. But this is literally what I put in front of 3 clients, 7 things you can do in estate planning. This is it. That's all you can do. There are 7 main categories. There's sales, meaning you can sell an asset to typically a trust for the benefit of the heirs. You can lend an asset. You can gift an asset. You hopefully will get discounts on the way the sale is structured or the loan is structured or the gifts are structured. Sales, loans, gifts, discount, charity, non-charitable deductions such as a pension plan, for instance, and life insurance. That's it. Everything else is a combination of these pieces. So for instance, a family limited partnership might be a combination of a gift and a discount. Doesn't have to include life insurance, doesn't have to include a deduction. But just to give you a thought process, what you want to do in the estate planning world is simplify what the prospective client thinks is a very complex world. And it is complex, but it doesn't have to be complex at their level. They only have to know, what do I spend and what do I get? What do I risk? What do I gain? So let's see. All right, here's the goals and objectives matrix that we use continuously all the time, everything. Please rank the following goals in order of importance, where 1 is the most important and 5 is the least important. The reason is it's very normal for people to have goals and objectives that conflict with other goals and objectives. So when we ask them to prioritize them, they've never thought of priorities. They put them all at number 1 until we ask them to start prioritizing. And by the way, I want the wife to fill it out separately from the husband. And when I get 2 of them back, supposedly one from the wife and one from the husband, and they're exactly the same, I know one of them did it. So I will give it back to them and say, I can't help you unless you're willing to help me. It's no different than walking into a doctor's office and failing to tell them where your pain is, failing to tell them why you're feeling bad. They can't do anything without help and information from you. So review of existing estate plan, maintaining our standard of living, maintaining control of our assets, minimizing onerous tax burdens on retirement assets, protecting future generations from themselves. So we want to protect your family from a failed business, from a drug addiction, from a failed marriage, from a failed business venture, and still make them or put them in a position where they can be more than protected so that they have the income that they need in order to continue their lives the way you intended. Converting ordinary income into capital gains, asset protection for us, asset protection for our heirs, equal distribution of assets to our heirs. That's an interesting category. Equal distribution of assets to our heirs. So, you know, our estate is worth $5 million and we want each of our children to get 1/3 of that. So then you say to them, well, are all 3 of them involved in the business? Well, no. So you want your son who's involved in the business to have 2 silent partners and he does all the work and they get half the profit. Well, no, that's not really what I mean. So I'm hopeful you can get the gist of what I'm saying about asking the question after the question, because you can't divide a business in thirds effectively and efficiently without creating huge family arguments. You can't take their house and divide it in thirds. You can't take their car and divide it in thirds. So equitable distribution of assets might mean equitable and equal value, but not necessarily of exactly the same assets. Income tax reduction, estate tax reduction, life insurance analysis, pay taxes on a discounted basis, philanthropy versus taxes without disinheriting the heirs, sell healthcare partners, stock without privacy, mentoring future generations. Let's see, what else? Following your goals and objectives, maintaining our current lifestyle, after taxes, index for inflation, maintain control of monies that would otherwise be lost to taxes, provide for an equitable distribution of assets upon your death among your children. For instance, if you got one child who's a drug addict and is in jail, do you want them getting half of your estate so when they get out of jail, they can blow it up their nose? Reduction of their onerous taxation on your IRA or profit sharing plan, reduction of estate taxes, pass maximum value to children, protect assets from the claims of judgment creditors for you, your children, your grandchildren, retain control of your assets, provide more clarity, reduce income tax, more involvement with exploring philanthropic planning options to meet your short and long-term objectives, philanthropy versus taxes. So here's a strategy matrix. So we first went through the goals and objectives. Then we went to the strategy matrix and we started sharing with them all of the possible things with some explanations of how they may or may not be appropriate for them. And we just keep going. Most of these they've never heard of. They have heard of a lot of them. We want to find out what they know, what they don't know. We want them to say to us, yes, I want one of those grants. I'll tell you a story. I'm sitting in a meeting with a very significant business owner who is just, the business that he was involved in was just sold, and his $5 million net worth just went to $150 million. And the tax attorney is explaining how to do a series of rolling grants. And this particular business owner said, well, wait a second, I don't know what a grat is. And so the attorney said, well, that's very simple. A grat is a grantor retained annuity trust. And he continued on his conversation. Now, the business owner wasn't confident enough to say, wait a second, all you did was substitute words for letters. I still don't know what it does. I had to jump in and I had to say, John, you know what you just did was substitute words for letters. What he wants to know is, what does a grantor retained annuity trust do? Why is it appropriate for him? How much does it cost? What's the upside? What's the downside? And the business owner said, slapped his hand on the table and goes, yes, that's what I want to know. So sometimes we have to act as an advocate for the client and an interpreter for the professional advisor. Private retirement trusts, state of California, Nevada self-settled spendthrift trust, California limited liability companies.
Well, this seemed like a pretty good place to kind of split the presentations here. It's amazing what Simon does without thinking, especially in regards to communication with clients, is unbelievable. I've been with him on multiple presentations with clients, as well as obviously all the training we do at the center. And the guy's forgotten more than most people know. But what's really nice is that he really enjoys coaching and training, which is why he wanted to start the center to start with. All right, one of the things the center does is once a quarter we do a live academy. We've got, and at the academy we bring in 18 speakers. It's all different topics, all related to either resources that you weren't aware of for your practice, or ideas and concepts that you can take back to increase your practice revenue or increase your prospecting. At the academy, we also have, we talk quite a bit about systems we have in place for lead generation as an example. So it's all things that increase practice revenue. This event that's coming up, the CTSR Live Academy, is being held May 11th to the 13th. So we're coming up on it pretty quick. It runs from 8 till 5 on day 1 and 2, and then from 8 to 4 on day 3. We do put in there that sometimes, you know, the questions come on and it goes sometimes a few minutes over, but for the most part, we try to stick pretty close to the schedule. If you want to find out about a little bit more about the event coming up, you can go to our website. It's yourctsr.com, and you can click under the events tab. You're also going to receive a email that'll come out shortly after this is over with a little more information about the Center for Tax Strategies and Resources, and also information on how to enroll. We are going to do a promo code here. Just keep in mind we're We're getting close on our room block. So if it sounds like something that you might enjoy attending, and I'm sure you will, you want to kind of jump on that before those room blocks are lifted, because we've got a really good room price. I think it's $127 a night, something like that. It's a really good deal. So to register for the event, you can go to our website, www.yourctsr.com, and then you'll see a tab right on the front page that says upcoming events. There's a little more information on the event itself. Also, all of you are going to receive an email shortly after this viewing that will give you a link and a video brochure on the center itself, give you a little bit more detail than what I'm going to take time with you right now going through. So make sure you check your email. Some of you need to check your junk mail because sometimes it goes to the junk mail first. So take a look. There's some interesting stuff we're sending you. You can, if you enter, it's $4.99 for members to attend, and it's $6.99 for non-members if you use the above promo code. So we're going to save you $100 if you type in April, capital APRIL 100, and that discount code is going to be good for you through Friday. So midnight of Friday that ends, and it goes back up to the $7.99 price for non-members and $5.99 for members. So and also we have some room blocks, so those fill up pretty quick. So you might want to jump on this and get the information that you need quickly and get yourself registered. It's an amazing 3 days. I want to give you a little idea what's going to be at the program. Now, this is the faculty that's speaking at this event, May 11 through 13. Harlan Acola, who's a national expert on reverse mortgages. By the way, reverse mortgages are pretty phenomenal. They're a lot different than I ever thought until I went through the training with Harlan, but it frees up some dollars for planning, and it's also kind of a hot topic. So Harlan's an expert, does a wonderful job explaining it. Ken Buckley has a premium financing protocol that he has that's unlike anyone I've ever seen. So we've asked him to come and share how he handles these cases, and the clients love what he does. Paul Chell is a disability insurance specialist, a small group, high net worth, does a lot of stuff with the C-suite. Not something I did in my practice much, but the stuff I've handed off to him created some really nice opportunities for the clients and some good commission back to me. Brian Edelman, national recognized cyber security expert. Now, we had him at a program prior. The liability you have with all the data you collect from the clients, it's substantial. And Brian will talk about things you do to safeguard your practice on that. Bruce Gendine is an unbelievable resource for pension plans. He's going to talk about some things you probably don't know about pension plans. So he's one of our resources. Bruce Givner, tax attorney out of Los Angeles. I got to say, one of the all-time smartest tax attorneys we've ever met. He's a permanent faculty member. Rick J is going to talk about ESOPs, employee savings programs. By the way, that creates a wonderful tax savings for the client if it's right for their business. It also creates some substantially large life insurance sales for the advisor that brought it to the table because of the liability involved with ESOPs. Kevin Jerry is going to talk about tangible property tax methods, which is an entirely new thing. It took this guy 800 hours to get certified. There's not a whole lot of people in the U.S. that know how to do it, but it creates some huge deductions for your business owner clients. Patrick Kelly is a national expert in tax-free retirement marketing, and he's got a retirement marketing program that he makes available to the members using his books and his credibility to get people in seats for either a live or a virtual marketing program seminar series. So you're going to love that. Kevin Knavel, LinkedIn's most recommended business speaker in 2020. Kevin knows more about the world's biggest Rolodex than anybody we've ever met. He definitely makes our members better at the things they do on social marketing. Dr. Vicki Rackner has been one of our board members since day one, and she understands how to market to doctors. So if you ever had any idea that you might want to put doctors in your medical professionals in your prospecting programs, she knows how to do it. She has a lot of help and provides a lot of training. Simon Singer, told you about him early on, our founder, killer at everything he does. He's going to spend a lot of time on stage at the event. Joe Struzzieri. Joe started the Southern California Institute Laureate Program. He is a tax attorney. He is an unbelievable leader in regards to teaching the industry how to create tax efficiencies. So not only is he a lawyer, but he's an educator at heart. We've actually had a bunch of our members have clients in front of him, and he's done a lot of engagements because he does really, really amazing things on succession planning, asset protection, as well as tax savings. So Joe's going to talk quite a few times at the event. And Dan Zeppelin has probably, I think, the most unique senior settlement situation design that he's set up, where he sends these policies to auction. And it's fascinating when somebody goes to auction because it puts so much more money in the client's pocket. That and several other topics at the upcoming Academy. Again, it's the 11th through the 13th. Check your email for the registration. And now, with that, I am going to connect you over to Joe Struzzieri, who's going to talk about saving a lot of taxes and getting out of a highly appreciated property or asset. And again, Joe will be there with us too at the Academy. So enjoy the rest of the show, and we'll talk to you again in a few minutes.
So that all being said, first, thank you very much for having me. We have about 45 minutes. Would that be right, Todd?
Be right. And then some questions if you'll sit around
Sure.
with us.
Joe, probably about halfway through too. I'll kind of jump in because I know you can't see our faces on the screen when you're presenting, but we're going to talk a little bit about the Academy for a couple minutes, somewhere in the middle. Okay.
Sure. Just tell me. Now, mind you gave an Italian attorney a microphone and a stage, and you're going to slow him down. I love that thought.
Gonna try.
Sure. Within this, I'm going to take 2 minutes first. Every time, and you guys, people who have done this regularly have heard me say this, every time you listen to a presenter, remember to understand what their bias is. How do they get paid? Where do they come from? What is their bias? How are they seeing the world? So my bias, my partner Steve and I, with other partners that we have running them, own 5 organizations. There's 3 of them. The Southern California Institute, very similar to the center that you belong to, started for very similar reasons. We put on over 250 programs a year, 2/3 to advisors, 1/3 to clients on legal, financial, tax, and counseling. Struzzieri Mancini, the law firm. My name is Joe Struzzieri. We're a mid-sized firm of now 7 attorneys as of yesterday, where we help successful families and business owners do 2 things: get to the heart of highly relevant matters, so counseling, and resolve messes. And that is the second largest way we get business, by saying we can help resolve the mess. In the areas of integrated tax and estate planning, what we're talking about today, business succession, and then family governance counseling or family business conflict counseling, the largest way we help advisors acquire large families or successful families and business owners, because wealthy families often have dysfunction within their business or themselves. Lastly, Founders Group. We help business owners with, do I keep and grow my business, or do I transition it to my family, to my employees, or to a third party, in whole or in part, now or later? So that gives you a bias of the way we think and what kind of things we do. We're going to talk about the 10 ways out of highly appreciated property. We'll talk about their typical plan, the 10 exits, and then helping clients understand and choose. First and foremost, this presentation by no means in 40 minutes could give every technical bit of every one of these. The goal of the presentation is to be able to give you language and tools to speak to other collaborative advisors and speak to prospects and speak to current clients and speak to past clients to say, you're considering selling or not based on a 1031 exchange, or selling or not based on a CRT ILEC combination. Have you considered all 10 ways out? So it causes the client to say, I'm sorry, say that again, to start the conversation, to restart the conversation. So the goal of the presentation today is to widen your perspective, give you language and tools to help acquire those clients or serve them well. So the typical plan. Clients that you will have that have property, that have had it for a long time, have a swap till you drop attitude. They've been using code sections 1031. Really old dogs will call them Starker exchanges, because Mrs. Starker is the one that caused this with the IRS, that the IRS then codified in 1031, where you can take a piece of property, sell it, give the money to an accommodator, and as long as you point and find properties within 45 days and close within 180, you don't pay a capital gains tax. So I have a piece of property that sold last week. I bought the dirt for 100,000. I built it for 5. It's got about 600,000 into it. Over 30 years, I've depreciated the $500,000 of the building. My basis is 100,000. It sold for 2.8. I've got a 2.7 capital gain. That means I've got $850,000 tax that I'd have to pay. If I take that property and I sell it and I stick the money with an accommodator, what's called a qualified intermediary, looks and smells and tastes like an escrow company, and they get it, and then I take that and I find, in the typical rule, either 90% of a bunch of properties, or I choose 3 properties that I will identify to do it within 45 days, and I close on that transaction within 180. I have to put that much money or more with at least the amount of debt. I have no debt, so I don't have to worry about that. It goes then, I don't, buys the new property, I pay no capital gains tax. Your clients know these rules down pat and have done it multiple times as they bought and sold and exchanged up the chain to get bigger properties. They know this stuff. You've got to deal with appreciation recapture I just talked about. And always be careful inside of B trusts and limited partnerships, because we do this swapping, because if I own a separate property, the day I die, the property gets a step up in basis. So if my heirs sell it, there's 0 capital gains tax. If I own a community property in a community property state, or community property in Alaska, if I live in a non-community property state, and one of us dies, my wife or I die, it gets a complete step in basis to where she can start to redepreciate, or she can sell it without having a capital gains tax, just like my heirs would. So community property rules help a lot. Notice how I killed myself off first. The 10 exits. So let's talk about 10 ways to do that that isn't a 1031. So we say getting off the 1031 exchange train without having to die. Client says, wait a minute, what do you mean? There's a way to do that? So we're going to cover each one of these 10 one at a time. I'll give you this list again at the end. So tenants in common.
Hey,
Let's
Joe,
give you a little bit. Yes, sir.
can I interrupt for a second?
Of course, you can do anything you want. It's
Yeah,
it's your center. I'm a beer loving guest.
I understand. So part of the problem with the 1031 exchange and the time frames of 180 days and 45 days is sometimes people are forced to get involved with properties that they may not otherwise get involved in. Isn't that so?
Very much so. So I'm under a gun right now. It closed last week. I'm 9 days into my, 9 days into my 45 of identifying. So there's pressure on me right now. All sorts of people want me to buy DSTs and a tenant in common and wind up this property. And in California, ADUs are very popular to get into these days. But I'm thinking to myself, well, hell, I lost 6% of my investment in the commission. I've got now 94% to invest. I'm going to put it somewhere. Where is it going to earn the most? Am I worried about losing the 1031 one day because of Joe Biden and crew, which is what they've got their eyes on? The pressure of this is pretty high. And older couples get really nervous about how do I find the thing, because they were happy to sell at a high market, but they don't want to pay in a high market. So you're right, there's a lot of pressure, Simon.
Thank you, Joe.
Oh, by all means. So a tenant in common. This is a historic way to do this. It's still a 1031 exchange, but instead of my selling my property, going to an accommodator and buying a singular property or a couple of them, I'm going to go buy a piece of property with Simon. We're going to own it together as tenants in common. So that tenants in common is a historic way. 2 people could own property that if one person dies, their estate gets it, as opposed to joint tenancy, 2 people have it, one person dies, it goes to the other. So within that, I'm going to be able to use the 1031 exchange rules. There was a company in Santa Barbara that were putting together tenants in common with multiple people buying into a piece of property. And the FINRA and the SEC looked over and they said, that looks and smells and tastes like a security. There was an assistant, a secretary in the office that was securities licensed, and they said you have to be securities licensed to do this. The industry just said, you mean you can sell real estate, buy something that I can get a commission on, and it qualifies for 1031, we're in. And hence the TIC world, or tenant in common, TIC world, was born. It was the wild, wild west in the beginning, people charging 2 to 5% to run it per year, charging 6% up front, charging exiting fees. And it turned out to be not such a great investment most of the time until the government got involved, white papers came out, and what ended up happening was it became a very regulated industry. Now it has securities returns like anywhere else, and you can do triple net properties through TICs, et cetera. Very common. Most people in the financial industry know this. Delaware statutory trusts are a variation of tenants in common, which we'll talk about in a little bit. Rental to residence to sale. Most of clients that have real estate portfolios have their historic home that they moved out of that they now rent as part of it. If they sell that rental, they depreciated the depth out of it, and it's going to cause a capital gain. So they said, well, I understand you can have 2 personal residences. What if I stop renting it and maybe let my daughter Taz live in it? And if she does, it'll be considered my second home. And I can then use this rule about $250,000 per person or $500,000 per couple to sell. I'd have to live in it 2 of the last 5 years or have a pro rata amount of that. So I could avoid $500,000 of capital gain. Now, you'd either need to move into it, or you definitely need to stop renting it, not even your family, or call it a second home. And if you lived in it for, let's say, 4/5 of the amount of time, as a couple, you get $400,000 of the exclusion. It's 2 of the last 5 years. So I could have lived in it for 2 years, starting 5 years ago and still qualify, or 2 years ending now. And if I'm going to pro rata about it, I could. So for people that are worried about a $500,000 less gain, great way to do it. Absent losing the income, which often they lose a family member in anyways. Next, shared remainder trust. Simon, how historic are CRTs?
If I remember correctly, Joe, I think they go back for more than 60 years, don't they?
Yep. And what is the instrument often included with the CRT?
Well, that depends if it was presented by a tax attorney or a CPA or a financial planner / insurance agent, because the way to replace the property would be a properly structured life insurance policy and an irrevocable trust.
So I agree with Simon. You'll get CPAs and attorneys that will present this and will forget to replace the asset for the kids. So I take my property, I put it inside of a charitable remainder trust, which I'm allowed to be the trustee of and still in charge of. The trust is an irrevocable trust. That trust says I'm going to get an income, either a stated amount or a percentage of the trust each year for the rest of my life and my wife's life. My own life, if I was single, the 2 of our lives, if we're, or joint life expectancy, if we're married. At the end of that time, that asset is going to go to a charity of our choice. And it could be something that's guided by our kids, et cetera, or a public charity, or a DAF. But let's think about something. If I put my asset in there, let's say my $2.8 million property with a $2.7 million gain that I have to pay an $850,000 tax for, it would only give me 1.95 at the end. Could I instead put it in this trust the next day, or the next day, a time later that I didn't have a buyer yet, a time later, sell it, it pays no capital gains tax, and then there's $2.8 million in here that's generating income for me. Now, Simon, what earns more, $1.95 million or $2.8 million?
I'm glad you asked me that, Joe. Not many people think to ask that, but I'm betting that it's the larger number.
Or it depends on who your advisor is. But at the end of that day, I have $850,000 more to invest. If I'm investing that and I'm getting a 6% return, I'm getting some 50 grand a year more than I would have. Oddly enough, if I dedicate half of that to insurance and half of that to going on more cruises, everybody wins except for the IRS. I get a greater income. I get to diversify this real estate asset for a diversified portfolio that my financial advisor can manage. My charity is going to get money when I die. My kids are going to get an asset that they want, which is cash, more than the property anyways. We're all good. This has been around forever. In a low interest rate, CRTs friggin' rock because of the way this can cook as I take out this percentage over time and my portfolio does better than that. I'm going to take out even larger amounts of money towards the back end of my life. I can even structure it to where it pays out more later. Now, in here for a financial advisor, we're now taking a real estate asset that is not managed at all. We're converting the whole thing into AUM, and they're buying a big life insurance policy, and they'd like to work with the rest of you, and they're going to tell your friends, their friends that think 1031 is the only way out, that you're help. Very traditional way to play it. Partial transfers. Could I gift part of this to my kids and keep up the rest in order to get a step up in some of it, but give my kids some early? Yes. And that's going to be important here in a minute because there's some interesting ways to do that. One of them is a gift up to step up. My mom is in her 80s. Let's say that she has a small estate, or that Biden doesn't reduce it down to 3.5 and we kept it 11.7. So small estate or that. Could I, as G2, gift to my mother my $2.8 million property? I've used up my gift, my amount that I can use by the time I die, but I can gift it there. She can then put it in a trust that will be included in the estate when she dies. But when it comes to me, it'll have a full step-up basis. I can start to redepreciate it, and it's creditor protected, and it will never pay the estate tax again because it's in a dynasty trust. So I get use of it, I get it creditor protected, and when I die, it goes to my kids, they get the same thing, and it never pays an estate tax because it qualified for GST. Wow, isn't that cool? Now, it's sad to think about my mom dying or somebody's parents dying, but unfortunately, it's going to happen. If I sat down and talked to my mom, she'd either say, oh my gosh, Joe, let's not talk about my dying, or she would say, any way that we can stop giving the money to the government, Joe, we should do. So gift up to step up is a great answer. Private annuity trusts. You cannot do these anymore, but what we're going to talk about in a minute is an extension of the old private annuity trust rules. So for a little bit of history, a private annuity trust was, I have my property, I sell it to Simon in a trust. Simon's my brother. So we're keeping it in the family. I sell it to this trust that Simon runs for an installment note. I do not pay capital gains taxes unless as I receive the installment payments. So let's say I get $1,000 a year. Out of that $1,000 a year, $30 or $30 is return on principal, $970 is capital gains, and I pay capital gains on $970. Not the $850,000, but $300. Simon then later this year sells it to a new buyer for $2.8 million. Simon's basis in that trust was 2.8, sold it for 2.8, no capital gains tax. The IRS in October 2006 said, for 2 years I've been telling you to stop it, really stop it, because it's a step transaction, because of what are known as the related party rules. So if you have one of these that you see, a private annuity trust, dated before October 2006, don't mess with it. If it's dated after October 2006, there were still promoters doing it, get them to a tax attorney or accountant to tell them how to unwind before they get in trouble. That's important because of the deferred sales trust rules. The deferred sales trust is a trademark term by the estate planning team, a company owned by Robert Binkley. There's been a great amount of marketing for this because they say, sell it, put it in a trust, buy securities. As you draw the money down, pay capital gains, but more money is making more money. So you have more money to manage, more income for later. And wink, wink, if you need principal, ask us. The wink, wink bothers everybody. There should be a third-party arm's length transaction. They're pretty good at what they do. The drawback is that the estate planning team keeps half of the money management, and if there's any profit at the end. In an intermediate installment sale, there are many trust companies entering this world that will allow the financial advisor to manage the whole asset. So within that, then, we want to make sure that it's a intermediate installment sale. If we're going to monetize it later, we have to worry about a $5 million rule. So if 2 years later, after the related party rules problems go away, if somebody wants to borrow money on the installment sale, they probably could. They can't originally because if you're not allowed to sell something for an installment and then take a loan against the installment, it's treated as all income. But after 2 years, probably not. So deferred sales trust, great answer. More common term for it for the IRS, intermediate installment sale. It solves for the same thing we talked about before, but instead of me selling it through a trust controlled by my brother, it's sold to a third-party trust, not controlled by me at all. So you're allowed to do this. So deferred sales trust marketed is an intermediate installment sale.
Hey, Joe, I know what this is.
Intermediate installment sale. I'm
I
sorry.
know what this is. Can you kind of talk briefly about the $5 million rule?
Sure. When you monetize, if you were going to borrow against the installment note after 2 years, and we'll talk next about doing it sooner, you're only allowed to delay the tax.
Well, I don't think I oversold Joe. His ideas, his capability, his tax savings, and quite honestly, his style with the client, which is really amazing when you watch it, because he really gets to know them and provides a lot of guidance. He doesn't speak in too much lawyer term. He actually speaks to him in English, so it makes him very unique. Okay, so again, just a quick reminder, we've got our live academy 11th through the 13th. It's at the Westgate Hotel in Vegas, which is the old Hilton where Elvis used to play. We've used that hotel a few times. We've gone to the bigger resorts. We've done some stuff over like Aria and at the Wynn, lovely places. This is still one of my favorites because it's perfectly sized. It's very comfortable, and it's the food is excellent that they do at the hotel. So anyway, it's we've got a room block. I think we've still got a few rooms left, so you want to jump in that kind of quick. We run from 8 to 5 day 1 and 2, and from 8 to 4 on day 3, so you can get out of there after a long day. We also, by the way, on the first night, the night of the 11th, we have rented a private club across the street from the hotel. We're doing a poolside 11-course meal, and then we've got some fun things just to kind of socialize, nice long cocktail hour through the evening, and we've got putting greens set up and some other things to kind of entertain you. So we think it's great at these events that you get to meet other folks in the business. And the speakers that are there in town, they all come to these events too, and it's a really nice way to rub shoulders and get some specific questions answered. So that's included as part of your $6.99 after discount. So that includes that fabulous dinner. So again, if you can check your email, we've already sent it to you. Registration plus some more additional information on the center and the benefits of being a member, which again, if you do or don't join, if you come to the event, you will walk away with ideas and concepts that you can bring back to your clients, increase your practice revenue. So again, it's April with a capital A, April 100 is that promo code when you're asked to enter it. That'll get you down to $6.99 for the non-members and $4.99 for the members to attend. If you want to talk to somebody about us or get a little more information, you can give us a call at 877-258-2837, or you can email us at thecenterteam@yourctsr.com. in my 37 plus years in the business, I've never been to a meeting that lasts 3 days where nobody gets up to go answer their phone. They don't want to miss what's coming up next, and this will not be any exception to that rule. So come and see us in fabulous Vegas, and I hope you have a wonderful balance of your day.